IRA vs 401k. Which one is better? Hey there, future millionaire. Americans have several choices when it comes to saving for retirement. Two of the most popular options are a 401k plan and an individual retirement account, IRA. Assets in 401k plans totaled $7.4 trillion as of year-end 2023, according to the investment company Institute, ICI. Meanwhile, IRAs had a massive $13.06 trillion balance in the same period, says ICI. Many people get the two plans confused, and it's understandable given the similarities. Both offer the potential for tax-deferred investment growth, or tax-free growth if you opt for the Roth versions of either plan, tax breaks on contributions, and the ability to invest in assets such as stocks and mutual funds that have a higher potential return than savings accounts and bonds. Below are the key ways in which a 401k and an IRA differ. We'll also discuss which one may be a better fit for your personal retirement situation. Before we begin, subscribe to our channel for more videos like this. What is an IRA? An IRA is an individual retirement account that allows anyone with earned income, and even their spouse, to save for retirement on a tax-advantaged basis. Inside an IRA, your money can grow tax-free or tax-deferred until you take it out at retirement. This special tax advantage allows your money to compound at a higher rate, letting you accumulate more over time. The annual contribution limit to an IRA is $7,000 in 2024, though this figure usually rises every few years. Those over age 50 can contribute an additional $1,000 each year. You can open an IRA at many different financial institutions, including banks and brokers, and you can buy several kinds of assets inside your IRA, including CDs, stocks, bonds, mutual funds, ETFs, and more. The best IRA accounts let you invest in potentially high-return assets such as stocks and stock funds. Types of IRAs. There are two major types of IRAs, and they differ in the tax advantages they offer you. The traditional IRA can allow you to save for retirement on a pre-tax basis, meaning that you won't pay taxes on any contributions you make to the account. The money inside the account can grow tax-deferred until you take it out in retirement, defined as age 59, 2 or later. When you withdraw the money, you'll pay taxes at ordinary income rates. After age 73, you'll be forced to take required minimum distributions each year. The tax deductibility of a traditional IRA depends on your income, as well as whether your employer offers a retirement plan. The Roth IRA allows you to save for retirement using after-tax money, meaning you won't enjoy a tax break on contributions. However, you will be able to grow your money tax-free and then withdraw it tax-free in retirement, defined as age 59, 2 or later. Unlike the traditional IRA, you won't be forced to take minimum withdrawals, and you can even pass the money down to your heirs tax-free. The Roth IRA has income restrictions, so if you make too much, you might not be able to take advantage of it. Those are some of the largest differences between the two major types of IRA, but you'll want to understand some of the other finer points of each IRA before deciding which is right for you. What is a 401k? A 401k plan is an employer-sponsored retirement plan that allows a company's workers to save for retirement on a tax-advantaged basis. In a 401k, money can grow tax-deferred or tax-free until withdrawn at retirement. Employees can deduct a portion of their salary from their paycheck and have it invested in potentially high-returning assets such as stock mutual funds. The annual contribution limit to a 401k is $23,000 in 2024, and this figure usually rises every few years. Those age 50 and over can make a $7,500 catch-up contribution each year. Starting in 2025, those age 60 to 63 can make up to a $10,000 catch-up contribution per year. You may only open a 401k plan if your employer offers one. The plan will provide a fixed set of investments, often mutual funds, that you may invest in. These funds typically invest in stocks, bonds, or a combination of the two, such as in target date funds. Many 401k plans also match a portion of the employee's contributions to the account, providing free money. An extra 3 to 5% of salary, sometimes more, is possible. Types of 401k plans. There are two major kinds of employer-sponsored 401k plans, and the key difference is the kind of tax advantage they offer. The traditional 401k lets employees save for retirement on a pre-tax basis, meaning you won't pay taxes on any contributions. The money in the account can grow tax-deferred until withdrawn at retirement, defined as starting at age 59, 2. When withdrawn in retirement, any funds are taxed at ordinary income rates. After age 73, you will have to take required minimum distributions each year. Importantly, regardless of your income, a traditional 401k is always tax-deductible. The Roth 401k lets employees save for retirement using after-tax money, meaning you'll pay taxes on any contributions. However, the money in the account can grow tax-free and then be withdrawn tax-free in retirement, defined as age 59, 1 or 2 or later. Starting in 2024, the Roth 401k will not have required minimum distributions. However, you can generally roll a Roth 401k into a Roth IRA with few or no tax consequences and no required distributions. Those are the largest differences between the two kinds of 401k plans, but one employer's plan may differ in important ways from another's, so it's important that you read the fine print on your plan to see what it allows and does not allow. Employee contributions to a 401k. Employee contributions to a 401k plan are limited to $23,000 in 2024. Employees can have the money seamlessly deducted from their paychecks and deposited into their accounts, making it easy for employees to participate in the plan and not feel as if they're missing the money. If they've opted to purchase mutual funds as part of their plan, the money will be automatically invested in those funds according to the investment plan. Employer matching contributions to a 401k. Many employers provide a matching contribution for some or all of an employee's 401k contribution, incentivizing employees to participate in the plan. For example, some employers may match 50% of an employee's contributions up to 8% of their salary each year. If the employee contributed 8%, the employer would add another 4%, and the employee would effectively enjoy a total of 12% saved. But if the employee contributed 10%, the employer would still add a maximum of 4%. Employers offer different matching amounts, and some employers may offer no match at all. Matching contributions can be treated as traditional 401k or Roth 401k deposits, regardless of which type of account the employee contributes to due to the Secure Act 2.0. However, any matching funds that are treated as a Roth 401k contribution are taxable. Many employers require matching contributions to vest over time. For example, if the employer requires 3 years of vesting, employees must remain with the company for at least 3 years before any matching funds become fully theirs. However, once the employee has surpassed the vesting period, any subsequent matching funds immediately become theirs. Matching funds may partially vest depending on the employee's length of service. For example, with a 3-year vesting schedule, an employee who stays 2 full years may be able to keep 2/3 of any matching funds. But the rules depend on the details in the employer's plan. Is it better to have a 401k or an IRA? With so many similarities, which one should investors choose? Well, if you can max out your contributions to both, then you won't have to choose, while enjoying the full advantages each has to offer. But even though it's permitted, many people can't afford to do so. Forced to choose, many experts believe the 401k is the clearly superior option. There is actually no comparing IRAs and 401ks, says Joseph Ade, a wealth advisor with Steel Peak Wealth Management in Beverly Hills, California, citing the 401k's higher contribution limit and the potential for an employer match. If you're not taking advantage of your 401k, you're missing out. However, financial advisors also stress that both plans remain valuable to retirement planning. IRAs and 401ks can both provide unique value to an individual's retirement strategy, with key uses and specific pros and cons worthy of consideration, says Michael Burke, CFP at Lido Advisors in Southbury, Connecticut. In any case, experts recommend that workers take full advantage of any matching funds on a 401k plan, since that's free money. After that, if you want to contribute to an IRA, the Roth IRA is a popular choice, then that's a decision that's up to you. Bottom line. The best retirement plan for an individual will often include both a 401k as well as an IRA, says Burke. By understanding the differences between the two, an individual can make better informed decisions and ensure they are getting the most value out of their investment choices. Thanks for watching.